Hey, Rob, we sort of clear up for our audience self-assessment? We hear about that a lot, but what does that actually mean? Because at one extreme, you could just go, oh, self-assessment. I'll decide what I want to put into my tax return. But let's get specific about what self-assessment actually means, and why that's important for everyone to understand.
Yeah, look, Bryce, someone could decide what they want to put in their tax return and make up a figure, but they're probably going to get some questions from us, right? So let's talk about the self-assessment system. And we know most people are wanting to do the right thing. And so basically the self-assessment system means that you're declaring to the ATO when you lodge a tax return, or any other form, that you're accepting the information you're providing to us is complete and accurate. And so that replaces the responsibility on the taxpayer to ensure that their tax return or the other form that they lodge is correct. The responsibility is not on the tax agent, it's on the taxpayer. Something to remember. And so like more than 96% of all tax compliance is voluntary. So it's kind of for the individuals not in business. So that comes in through the tax return. 96% of taxes we assess as correct. So that kind of means that the majority of people are being accurate and complete in the information they provide to us when they lodge their tax return in line with the self-assessment program. It doesn't mean you can claim whatever you want, though.
I'm hoping you can confirm it here.
Look, we have lots of checks and balances as we lodge a tax return, and we get data from a range of sources that we use to compare against the information you've put in your tax return. Some of it we even try and pre-fill into your tax return for you, such as your interest and your salary data, so it's there for you to help you get it right the first time. But we do use that data to see if there's any discrepancies, and if there is, we'll kind of let you know or reach out to you. And they're becoming more sophisticated, Ben and Bryce, over time. Our processes there, and that's really because of we check a lot of stuff against third data, and over a period of time, the data that we're able to collect is better, and we get more data, and that means that we can kind of help people as they're lodging their tax return to try and get them in the right direction. We want to make sure people get it right the first time where possible. As I said, 96% of people. So kind of that's the self-assessment system. Essentially, you're responsible for what you put in your tax return.
In an age where AI is now becoming more prevalent than ever, but prior to AI, there was a whole bunch of things that you guys could do to actually cross-check some of this data. So if someone lodges their tax return, people need to know it's not in isolation, because this is not your first rodeo, is it? There's other things that you get to do with other types of data to cross-check the tax returns. What sort of data do you get access to?
So Bryce, we get a range of data from different sources that we then use to kind of help people with their tax return for different elements of it, and then kind of identify where something doesn't also look right, and just kind of get check up on that. But if we talk about rental properties, so we do get a lot of data when it comes to rental properties. So this includes landlord insurance as one, which provides kind of information around insurance payouts that should be reported as rental income. And also landlord insurance premium expenses. We get residential investment property loan data, which provides interest expense and borrowing expenses, but also helps us to identify where someone is essentially renting their property out. We have real property transfer data, which kind of provides us information as to when someone might sell their property, sell their investment property. So that's obviously allows us to identify when someone might have had a capital gain that they need to report on the tax return. We have rental bond information data that provides details around the bonds that have been paid. And so that obviously needs to be reported as income, but also once again, an indication that someone is renting their property out. And we have data from the sharing economy platforms, which are your short-term accommodation provider platforms, which provides income amounts, but also fees that are obviously deductible as the expense you have to pay to the platform. And we also get property management data, which obviously includes rental income, but water rates, property management fees, and other deductible expenses that the property manager may pay. So we get all of that. we get this data as well through software providers, and they're kind of have to give us the rental expense data for residential properties that are managed by a property manager. So really, that gives us a really rich picture around when someone, it allows us to identify when someone is renting out their property, but also gives us a lot of information to help people get their return right, or identify perhaps when someone's missed something on their tax return.
And Rob, often around the time of the tax season, we are getting communications from the ATO reminding us of the areas that the ATO will be focusing in on, and often rental properties is part of that focus to try and get the accuracy right. Do you audit that type of information? And when you do that, what sort of insights do you learn from that?
Yeah, man. So we use our audit program, but also our data kind of matching and data analytics program to kind of identify areas where we think taxpayers that have rental properties are getting a little bit confused at times. One area which is pretty interesting, but we're not surprised at all, is the difference that landlords seem to get confused by gross rent and net rent, and kind of incorrectly put it in the return. And that's for both long and short-term rentals. So gross is the full amount, right? So you've got to report the gross rent without any expenses taken out. But what we've seen is, instead of reporting the gross rent, some property investors, use the net rent from their report they've got from the rental property manager, which includes all the expenses that you could have deducted or potentially deducted in generating your rental income. And then they go and include all the other expenses again in their tax return. So they're essentially double dipping, and we kind of say it's a bit like good party etiquette, right? You don't double dip the chip twice, so don't double dip your expenses twice. So it's just about, that's one really good example around where just a lack of understanding around the difference between gross and net rent can actually lead to some compliance issues for the taxpayer.
Ben, we got in trouble as a kid for double dipping, and now we'll get in trouble as an adult for double dipping as well. But it kind of makes sense. But look, I think it's always important for everyone to know that ignorance is no defence either. So if you ignorantly did that, that's not going to get you off the hook, right? But there is it's a fundamental accounting concept that you just talked about, net versus gross, and making sure you don't double dip. But it would seem that you, as comical as that might sound for Ben and I now, and some of our audience, it's not as if you haven't found examples of it, is it?
No, that's right, Bryce, and that's why we're trying to educate people. We know that not all property investors have probably done accounting or done finance. They might be tradies, labourers, teachers. They might have not accounting teachers, but so they might have not have a background, and so some of these concepts might not be as evident as they are to us, and new as they are to others. And that's why we're trying to educate people. We have identified taxpayers who've just failed to report all their rental income, yet they have a property manager looking after the place. That is a concern to us. That one is you're gonna get a call from us about that one, right? So, there is a bit where we do want to try and educate those people that are trying to do the right thing to help them comply and get the tax return right. But those that kind of choose not to, we will be in contact with them.
Yeah, no, we shouldn't laugh at that. But I mean, it does seem quite ironic that you'd have a property manager and you've received no rental income over the course of the 12 months of operating that property. Oh, there are funny people in this world.
Yeah, let's say, Ben, that one does cause us to ask a question when we see it.
I suspect it would.